USSG. It's new, but it made a splash, and I'll tell you why. Because look at the assets in this: 1.7 billion, and it's basically a couple months old. So this is a big launch along with an iShares that a Finnish insurer seeded. So a lot of that money came in right off the bat. And look, the name looks like all of them, right? But what does it do? It's kind of in between one that goes hardcore after, say, the top 100 best scores in ESG, and one that just surgically removes a couple companies. It's kind of in between. So let's look at the holdings. What do you get here? The portfolio is going to look very similar to like the S&P, right? Except it's going to be missing some key stocks here, right? So take FANG. You're not going to get Facebook, Amazon, or Netflix, but you do get Google. You see you got Microsoft there. So you get some, you don't get some, and that's really what ESG is all about. What do you get, what don't you get? Let's look at the performance of this versus the market, and you can see it moves very similar. But you're going to deviate a little bit, again, because you don't have some of those FANG names, and right now that's actually working. It's outperforming the market, but again, I would just, when you see this, that could reverse. So I think, Scarlett, the thing with these is you're going to have to just really look at the holdings. Do you want it? And compare it to the S&P.
Yeah, do your due diligence. All right, Still with me is Luke Oliver of DWS Group. And Luke, ESG's group time has clearly arrived. There's a lot of buzz. People are doing their homework on it. Are they taking money out of vanilla index funds and putting it into ESG funds, or is it still mainly being seeded by big pension funds?
A bit of both. So we're seeing a big move towards ESG internationally. So a lot of international institutions are some of the big players behind these moves. And of course, they use US ETFs and US funds also, but we're definitely seeing that adoption now, more wholesale, more diverse. It's not just coming from those one or two big pension funds.
Let's talk about, okay, so what's in it? Okay, some people, Nike's in it. Okay, well, okay, maybe they're fine. Something's not in it, like some of those FANG names. Berkshire Hathaway is in literally no ESG. Warren Buffett, just not ESG-ish. What about this concept of throwing babies out with the bathwater? I mean, how many of these companies can you not hold and expect to outperform?
Well, that's part of the challenge with ESG. When you look inside this fund at the holdings, we aren't expecting you to say, oh, these are all green, environmental, social governance companies. You're supposed to look at it and say, this looks like a large cap core exposure to the US market. And in fact, then what we do is tailor that to make it more ESG friendly by filtering out. We take out some controversial firms at top level, and then we factor in USG for the top 50% of market cap.
And are people supposed to replace this with their whole equity position, or add it on because, hey, it's going to have the alpha down the road?
Well, something like this is a wholesale replacement. So you can add this to your exposure. We're not looking to give you, we're not presenting an alpha story off the bat. We're talking about positioning your large cap core price, core positioning, core sector allocations, but giving you something that you can use in place of that benchmark.
And of course, there's been a big jump in assets, as you were telling us earlier, but it's tiny when you compare it to, say, value funds or low vol funds.
Yeah, we just showed a chart showing that the average ESG ETF has 200 million. That's about a fifth lower than the average ETF, which is about 1.1 billion. You can see other categories. In other words, there's just too many products for the assets. How high are your hopes?
Very high. I mean, we've seen 24 billion, I think, is in US ETFs, the 100 or so that you mentioned, and we've seen that grow incredibly. 8 billion last year and 15 billion over the last couple of years. So there's a big increase, and what we're seeing now is adoption in the US. And I think part of that is coming from the trend is picking up. Secondly, the education is starting to kick in. This isn't about being activist. It's about having core exposure and doing so in a way that that is actually, there's not a conflict between being a fiduciary and investing in ESG.
What's the biggest risk to adoption? What's getting in the way?
Well, what was getting in the way is by either just including the really high-scoring ESG or just excluding whole sectors that you didn't like. Your performance and risk look nothing like the benchmark. Products like this allow you to really have that core price, core allocation. So that is really going to go a long way. The tracking error to the benchmark are particularly low in these products. So I think that's where the adoption becomes less risky for people.